just wondering, let's start off with Asia, which is an important region for you. It contributes to most of your profit. Taking a look at China, expectations of a slowdown given the massive lockdowns right now. How will that play out for the second quarter for HSBC?
Well, look, I mean, probably no different to what we saw in the first quarter with our Hong Kong franchise, with significant lockdowns in place. Anything that was being sold through the branch network was impacted. We did see a decline in wealth product sales, new mortgage applications, commercial lending. The good news is I think we've been investing materially into digital over the last few years, so we have been able to migrate a lot of customer activity onto digital. In China at the moment, we're obviously going through some very severe lockdowns in places like Shanghai. Main focus at the moment is making sure that both our staff and our customers, we're helping them in any way that we can. But we do think we will see a slowdown in China coming over the coming quarters. But to date, we're not seeing that in the numbers. We're seeing, continued good lending growth, up about 10% year on year in China, and good revenue growth coming through.
If there are more lockdowns, if China slows down more than expected, and expectations are that it will, we've seen bank after bank cutting their growth projection for China for the year. How might that play out for HSBC, especially for businesses like wealth management, which relies on face-to-face interaction?
Yeah, remember, we're a relatively small player in China. We are the biggest international bank overall in China, but our market share overall is less than 0.2%. I think we're continuing with our long-term plans to grow our wealth franchise there. We see no reason to slow it down, despite some short-term dislocation because of the Omicron variant. But overall, we remain big China bulls. And when we talk about a China slowdown, we're still expecting to see growth rates of around 5% this year and next year, which is still very healthy compared to expectations in the West.
I mean, that may be the case, but you took $450 million worth of provisions at the beginning of the year for China real estate exposure. I'm wondering what you're seeing in the data at the moment, what kind of story that tells you about what to expect for the remainder of the year. Are things improving a little bit at all?
Yeah, look, I think in the China real estate sector, there's been two prevailing features of the sector. I mean, the first has been the policy tightening that you're all aware of that happened at the back end of last year. That clearly had a big liquidity squeeze on the sector. We are beginning with some of the policy easing that we've seen in recent months for that beginning to benefit the sector. However, we are continuing to see fairly weak underlying conditions for the residential real estate market. We did have a number of small Chinese real estate companies move into default in the quarter. We did take another $160 million of provisions. Together with Russia, it's one of two portfolios that we're spending more time on at the moment.
Is the worst over for China's real estate, Ewen?
Oh, look, I think that's a big call. Certainly with the policy easing, I think some of the tight liquidity conditions we saw at the back end of last year and earlier this year are beginning to ease. We think we may not be at the worst, but we don't see further significant downside with our portfolio at the moment.
Ewen, I take you to the headline that says that Russia exposures, basically you booked $1.3 billion worth of Russia exposures in the first quarter. Are you making any additional provisions at this point, or at least preparing to make any further provisions? And is a conversation on the way within HSBC at the very top level about maybe pulling back out of Russia, given that other banks have done that for reasons of protecting reputation?
Yeah, look, overall, we have a relatively small business in Russia. It's mainly there to support multinational corporates. We are in dialogue with those corporates at the moment about what they want to do, and we are working with them largely to manage down their own franchises. So for the time being, we're closed for new business, but we are working with our existing customer base to manage through what is a very, very difficult situation for them in their Russian businesses. We did take some additional provisions in the quarter against the balance sheet that we have there. We took around $250 million of additional provisions for Russia exposures, and we do think that that's a fairly complete provision for everything that we can see at the moment.
Ewen, what are the chances that HSBC will do what its peers are doing, the likes of Goldman, Citi, JP Morgan, making an exit from Russia by fall? Might HSBC do the same?
Look, I think it's for every bank to work with its customers and figure out what's in the best interests of for their customers. And for us, our client base are mainly multinational corporates. We don't have a retail operation there. We are working with those customers, and we're in dialogue with each of them about what their long-term plans are. I think you should expect that our business in Russia will slowly reduce over the year as our customers reduce activity there.
And last time we caught up, Ewen, the conversation was around multiple 25 basis point hikes from the Fed. That conversation's evolved, and now it seems to be the norm to talk about multiple 50 bip moves. How is that likely to give your bottom line a boost, especially since HSBC is even more rate sensitive than some of your other banks?
Look, we think it'll be a massive benefit to returns, P&L, distribution capacity over the next 12 to 18 months. Our net interest margin in this quarter was up 7 basis points. That's the first time it's up since 2020. Our net interest margin has not been at this level since the first half of 2020. And that's just at the very start of what we see as a very firm set of rate rises coming through. We've said that we want to get back to double-digit returns next year. We're very confident in getting back there. I think that will be turbocharged by rate rises. So we're very optimistic about the outlook over the next 12 to 18 months.
Higher rates is great for HSBC. What about the impact on your corporate clients? How might this play out?
Look, we are obviously cognizant of the fact that the inflationary impact is having both on all of our clients, whether they be retail clients or corporate clients. It's also having an impact internally on our cost base. Sort of fixed pay increases this year were double what they were a year ago. Very much in line with what we thought was appropriate to pay our workforce. So we're seeing that cost pressure, both outside and inside the organisation. I think the good news inside the organisation is that we're managing to keep costs under control. They were down 2% year on year, and we continue to be committed to keep costs flat this year, despite the inflationary pressures we're seeing.
With things going well on the net interest margin side of the story for the remainder of the year, or likely to go well, how much more headroom is there in the buyback/dividend conversation? I mean, some of the people that I've spoken to suggest that HSBC has tended to compensate in terms of dividends a bit higher than sort of the average. Is there an argument to be made to rebase the dividend and at the same time perhaps boost the buyback?
Yeah, well, we've announced today that we've just completed the $2 billion buyback program that was underway, that we completed a few days ago. We're intending to launch a further $1 billion buyback next week, following AGM approval, which is at the back end of this week. I do think on the balance of dividends versus buybacks, we see our primary tool to distribute by way of dividends. We saw a very healthy increase in dividends last year. I do think, our capital base is now back within our target range of 14 to 14.5%. So I think you should expect the shift for us to be more distribution by way of dividends rather than distribution by way of buybacks.
Ewen, we're hearing from we're hearing murmurs on the ground and activist investors pushing for HSBC to split Asia versus non-Asia to boost valuations. Are you hearing that, getting that feedback from any investor?
We're very comfortable with the strategy we've got. We think if we can execute this strategy, we get back to double-digit returns next year. We think that when we get back to double-digit returns, the share price should be substantially higher than where it is today. So, we've had all kinds of ideas thrown at us over the years. We do think the strategy that we're executing is the right one. We're not closed off to hearing alternative views, but we do think executing this strategy will be one that delivers a lot of shareholder value over the next 12 to 18 months.
I want to take the story back to Hong Kong, of course, sort of the key base for HSBC. Run me through what it's like at the moment to retain talent, even attract talent. You said at the beginning of the year that it still wasn't an issue. Much has happened since. Is that still the case? Are you needing to pay more to keep people, get people to Hong Kong?
Yeah, look, I think our position in Hong Kong is very different to most international banks. I mean, people know that we are firmly committed to Hong Kong. I know in my own team, for example, two of my most recent senior hires are individuals who don't live in Hong Kong, who are committed to moving there in the coming months. So we're not having any issues either retaining staff or attracting staff. But I think our position in Hong Kong is relatively unique to others. We can offer big, attractive growth jobs for people in Hong Kong. With the travel restrictions now down to a week of quarantine, I think that will make a massive difference too about people's ability to travel both internationally and come back home